James has watched his financial strategy change 3 times over the past decade, not because he discovered better information each time, but because the problems money solves at different income levels are genuinely different problems. At $50,000, the question is whether the money will last the month. At $100,000, the question shifts to whether the money is actually going somewhere useful or quietly disappearing into lifestyle. Above $150,000, the primary financial problem stops being income entirely and becomes something most people are not prepared for: taxes consuming a third of every dollar earned, and the strategic question of when exactly to hand that money over. The mistake most financial advice makes is treating these 3 situations as variations of the same problem. They are not. Different income levels require different priorities, different tools, and different mental frameworks. This video covers all 3. $50,000, building the foundation. James's first real job out of college paid him $42,000. Adjusted for how prices have moved since then, that is roughly equivalent to $50,000 today. He remembers that period clearly. The math was always tight, the margin for error was small, and every financial decision felt heavier than it probably needed to. What makes the $50,000 income level distinct is that there is very little room to absorb mistakes. A single unexpected expense, a car repair, a medical bill, an appliance that quits, can reset months of careful saving in a single afternoon. The financial strategy at this level is therefore not primarily about optimization. It is about building enough stability that the ordinary disruptions of life stop feeling like emergencies. The first priority is eliminating high-interest consumer debt, particularly credit card balances. The average American carries a credit card balance in the mid-thousands at interest rates exceeding 20% annually. On a $50,000 income, that interest expense represents money that could be funding everything else on this list, and it's compounding continuously against any progress being made. This debt comes first because nothing else works as well while it exists. The second priority is capturing any employer match on a retirement plan. If an employer matches contributions up to a certain percentage of salary, that match is an immediate guaranteed return on the contributed amount that no investment strategy can reliably replicate. A 50% match means a 50% return before the market does anything. Skipping it to address other financial goals is leaving real money on the table. The third priority is establishing a starter emergency fund. Not the full 3 to 6 months recommended as the eventual target, but a more achievable initial goal of 1 month of essential expenses. For someone earning $50,000, that means roughly $3,000 sitting in a high-yield savings account, untouched, earning meaningful interest while it waits. This amount is enough to absorb most ordinary disruptions without creating new debt. That protection makes everything else more stable. After consumer debt is eliminated and these foundations are in place, a Roth IRA becomes the most powerful tool available. At $50,000 in annual income, most people are in a relatively low federal tax bracket, which means contributions to a Roth account are made at a favorable rate, and every dollar of growth from that point forward is permanently tax-free. The contribution limit allows for meaningful annual investment, even if reaching it requires time. Starting with even $200 monthly at 25 and maintaining it consistently produces a substantial retirement sum over a full career at historical market returns. The final strategic consideration at this income level is the value of time and skill investment. Earning $50,000 is not a permanent destination for most people. It is an early stage. The most valuable financial move available is often not a financial move at all, but a career move. A certification, a degree completion, a skill that opens access to better compensated roles. An additional $10,000 in annual salary, maintained across a 30-year career, produces a significantly larger lifetime wealth outcome than most investment optimizations could generate on a $50,000 base. $100,000. Automation and optimization. When James crossed into 6-figure income, something unexpected happened. He assumed the financial stress would disappear. Instead, it shifted. The margin was larger, but the spending had quietly expanded to meet it, and after a few months, he realized his savings rate had not meaningfully improved, despite earning considerably more. This is the defining challenge of the $100,000 income level. The money is sufficient to fund a comfortable life and meaningful savings simultaneously, but without deliberate structure, the comfortable life tends to absorb the savings before they happen. The strategy at this level is therefore about automation, building systems that move money to the right places before spending decisions can intercept it. The most effective framework James eventually adopted was what some planners call a reverse budget. Rather than tracking every expense and saving what remains, he automated a fixed transfer to savings and investment accounts on payday before he could see or spend the money. The remaining balance became the operating budget. Spending naturally calibrated to what was available. The discipline required was front-loaded into the setup rather than recurring monthly. A 15% savings rate on a $100,000 gross salary after taxes, roughly $6,000 annually, invested consistently in diversified index funds from age 30 produces over $2 million by retirement at historical average market returns. That number is achievable on this income without extreme sacrifice. It simply requires the automation to happen before lifestyle makes the competing claim. The health savings account deserves attention at this income level for people with qualifying high-deductible health coverage. It is the only savings vehicle in the tax code that offers 3 simultaneous tax advantages. Contributions reduce taxable income now. Growth inside the account is never taxed, and withdrawals for qualified medical expenses are also untaxed. For someone in a meaningful tax bracket, maximizing HSA contributions is one of the highest return available financial moves, particularly if current medical expenses can be paid out of pocket and receipts preserved, allowing the account to compound untouched for years while future reimbursements remain available without time limit. The third essential tool at this income level is calculating a personal financial independence number. The framework is straightforward. Annual living expenses multiplied by 25 represents the invested portfolio size at which a 4% annual withdrawal can theoretically sustain indefinite spending. Someone spending $60,000 annually needs approximately $1.5 million invested to be financially independent. Someone spending $45,000 needs roughly $1.1 million. Knowing this number converts abstract financial goals into a concrete target with a calculable timeline, and it makes every financial decision easier to evaluate against a specific finish line. $150,000 and above. Tax as the primary challenge. James's circumstances changed again in his late 30s. By then, his income had reached this tier, and he discovered that the primary financial challenge had become neither cash flow nor savings discipline. It was taxes. Above $150,000, federal marginal rates climbed to 32% and above. Add state income tax in most states, and the effective marginal rate on additional earnings frequently exceeds 40%. At this level, a dollar earned and not shielded from taxes is a dollar sending nearly half of itself to government before any investment or spending can happen. Tax optimization, which at lower income levels is a useful secondary consideration, becomes the central financial strategy. The backdoor Roth IRA is the first tool to understand at this income level. Direct contributions to a Roth IRA phase out above certain income thresholds and disappear entirely above higher limits. The backdoor approach circumvents this. A non-deductible contribution is made to a traditional IRA without any income restriction, then immediately converted to a Roth account. The mechanics require attention to existing IRA balances to avoid complications, but for someone without existing traditional IRA assets, the process is straightforward and preserves access to tax-free retirement growth regardless of income. For those whose employers offer after-tax 401k contributions with in-plan Roth conversion, a benefit sometimes called the mega backdoor Roth, the opportunity is considerably larger. The standard 401k limit allows contributions in the mid-20,000s annually. The total combined limit, including employer contributions and after-tax employee contributions, is substantially higher. Where this benefit is available, it enables tax-free compounding on amounts that would otherwise be limited by the standard caps. Not every employer offers this, but for those who do, it is among the most powerful wealth-building tools available at high income levels. Portfolio diversification becomes a more important consideration at this income level as well. Someone accumulating meaningful assets has more to lose from concentration risk than someone in earlier wealth-building stages. A broadly diversified equity allocation remains appropriate, with international exposure providing some hedge against domestic market concentration. As years pass and the accumulated portfolio grows, gradually shifting toward reduced volatility becomes logical, not because stocks stop working, but because a large enough portfolio generates sufficient returns at lower risk that a smaller portfolio would require to hit the same absolute dollar targets. Equity compensation, restricted stock units, stock options, or profit sharing is common at incomes above this threshold and introduces its own tax considerations. Shares that vest create ordinary income in the vesting year, regardless of whether they are sold. The decision to sell immediately and diversify versus hold and accept concentration risk requires individual analysis, but the general principle that no more than a third of a portfolio should be concentrated in any single company, including an employer, is well supported by both the math and the documented experience of people who have learned this lesson by paying for it. James's financial life at $50,000, at $100,000, and above $150,000 were genuinely different situations, requiring genuinely different approaches. The mistake he made early on was treating income growth as a simple amplifier of the same basic strategy, rather than as a transition into a qualitatively different set of problems. The foundation level is about stability and debt. The optimization level is about automation and a concrete target. The tax level is about keeping what is earned through tools that exist specifically to reduce what the government collects before the compounding can begin. Each level builds on the one before it. The habits built at $50,000 make the automation at $100,000 possible. The clarity developed at $100,000 makes the tax strategy at higher incomes feel purposeful rather than arbitrary. Whatever level you are at today, the strategy starts at the level you are actually at, not the one you are working toward. Start there, build forward.